If it's been 5 years since you bought your home and you haven't reviewed your mortgage, grab a pen. I'll show you how refinancing can cut monthly expenses, and also how I allocate part of my equity into cash value life insurance to protect the mortgage and build long-term value. Now, a lot of us are sitting on equity while struggling with debt. Refinancing means you replace an existing mortgage with a new one, often at a new term, a new rate, or amortization, and you can roll high interest debt into it. In Canada, lenders typically allow you to borrow up to 80% of your home's value on refinancing. The exact values may vary depending on the lender, so you need to talk to your broker about that. So why refinance? Because mortgage rates are usually much lower than credit cards or unsecured loans. So the same debts can cost you less per month. Let's use my friend John as an example. His monthly debt burden was about $4,000. It's made up of mortgage payments, student loan, car loan, credit card balances. He bought his home 5 years ago. Prices have risen, balances have dropped, so he likely has tappable equity. Now let's use round numbers here. If John's home is worth $750 today, that is what he could sell the home if he chooses to sell today. Lenders may allow a new mortgage up to $600,000, which is 80% of the current market value. Are you following so far? Now, assuming John still owes the bank $415,000 from his existing mortgage, when he refinances, the bank will pay off his old mortgage, that's $415,000, with part of the new mortgage, which is $600,000 he could get. Now, the difference between the new mortgage amount, which is $600,000, and what he still owes, $415,000, is what he can access as cash out equity. Now, he can use this to pay off high interest debts and then cover closing costs and a small emergency buffer. You can also fund a protection plus wealth strategy via universal life insurance. So same household, same debts, but restructured. If John's new mortgage payment is about $3,000, he just created $1,000 per month in positive cash flow. Now that's a breathing room for a family. Here's where the wealthy think differently. They don't put all the eggs in one basket. A universal life insurance policy can do two things at once. It can provide debt benefits that can protect your family and extinguish the mortgage. It can also build cash value you can access later for opportunities and emergencies or even retirement planning. Instead of every dollar going only to debt or only to markets, you're adding a protected pillar to your plan. So you can set up the policy with a one-time amount or simply commit a small monthly chunk to your new cash flow. This also helps you have guaranteed final expense benefits that exceeds the mortgage value. It also gives you cash value that grow quietly in the background. That way, you've cleaned up your payments and installed a safety net. So here's a quick reality check. Refinancing can reset your amortization and increase total interest over the long run. Also note that there can be penalties and closing costs. Universal life insurance requires qualification and discipline. Always run your exact numbers with a mortgage broker and licensed financial advisor. Now, if you want my refi and debt cleanup worksheets, comment refi. If you want Universal Life Explainer ebook, comment secret and I'll send it to you free of charge. Now go ahead and share this with a friend who needs a breathing room, and don't forget to subscribe for more.